Hey everybody, Rahul Shah, Doc Shah Financial, and it's a late night here, late night at the Doc Shah Financial headquarters. As you can see, we have a very extravagant setup here, and I thought I would make this video for high earners and how to actually defer a lot of taxes and save quite a bit of money in the process. So let's go ahead and jump right in. And the first way is through asset location. You want to put your lowest appreciating assets in a pre-tax account like a 401k. You want to put your fastest appreciating assets in a Roth account like a Roth IRA, and you want to put your most tax efficient accounts in a taxable account just like a standard brokerage. Why? Well, if you put your least appreciating assets in a pre-tax account, that means that they won't grow a lot. So ultimately, when you take them out, you won't pay a big tax. The same is true in reverse for a Roth IRA. If you put your fastest appreciating assets in this account, well, they'll grow a lot, and then you'll get to take that out tax-free. And if you put tax-efficient investments in a taxable account, like let's say muni bonds in your brokerage account, well, guess what? Those muni bonds are tax-exempt at the federal level and generally tax-exempt at the state level too. So even though that taxable account, normally you'd pay taxes, because that muni bond negates it, you won't pay tax in that account. So you want to look at what you want to own and then place everything in their appropriate account, and you'll save a lot in taxes if you do that the right way. Okay, the second way is using your taxable account, right, your brokerage account, to hold long-term investments. So when you hold an investment, let's just say a stock for short term, which is 365 days or less, you're going to get hit with an ordinary income tax on your capital gains. So that means that if you had a $100,000 gain that you only held for, let's say, 365 days, then you're going to pay $37,000 in tax if you are a high earner and you're at the highest federal tax bracket. Now, if you held it for 366 days, right, longer than a year, on that $100,000 capital gain, you'd only pay a 20% long-term capital gains tax at the highest level, so you'd pay $20,000 in capital gains tax. That's a huge difference. In fact, if you take that $17,000 difference and you invest it for 35 years and get 8%, that's $276,000 that one good decision made you. So you just take your investments and hold them for the long term, and you can make a lot of money, not only what you save in taxes, but then ultimately when you take that saving and you reinvest it and it compounds. It's unbelievable if you do this every single year. Okay, the third thing is an HSA. So that is a health savings account, and you get this account if you have a high deductible health plan. The HSA is the only triple tax advantage account. That means you don't pay tax when you put money into the account, all the earnings grow tax-free, and then you can take it out tax-free for qualified medical expenses. The HSA is unbelievable, and if you max it out every year, you could have millions of dollars in retirement to take care of your health when you really need it the most. So don't forget the HSA. Use it, especially if you're a high earner. Okay, number 4 is not very well heard of, but it's called a non-qualified deferred compensation plan. And talk to your employer if they offer this. Not all employers do. But the way it works is that if you make a lot of money today, this plan allows you to actually defer some of your income into the future when presumably you're in retirement and your tax rate is lower. So let's say you were making $600,000 a year. Well, if you're able to defer, let's say $300,000 of your income to a later date in retirement, what would the result be? Well, immediately your taxable income would be lower because your income's cut in half. But then also in retirement, because you may not have any other income sources, your tax rate then is going to be a lot lower. And so you can save easily tens of thousands of dollars doing this. Now, there are risks to doing this, so make sure you weigh the pros and cons, but this video is just sort of a general overview of different strategies to delve into more. Okay, number 5 is called direct indexing. So a lot of people like to tax loss harvest at the end of the year, especially for high income earners. They can catch a little bit of a tax break if they have some capital losses. But the thing is that when you do direct indexing, you're individually buying every single stock in an index. When you buy an ETF that tracks an index, you're owning a basket. So direct indexing is like picking the individual fruits, and ETF buying is like owning the basket that owns those same individual fruits. The benefit of direct indexing is that because you own all these individual companies, you can actually strategically sell off the ones that are at a loss, realize that capital loss, so tax loss harvest specific investments. With an ETF, the only way you can tax loss harvest is if that whole basket were to go negative, and that doesn't always happen. So you get a lot more flexibility when you direct index, especially if you're a high earner. Okay, number 6 is max out your 401k, especially if you are a high earner, and get the match that your employer offers. You as an individual can contribute $23,000, and the total you can put into the account with the employer contribution is $69,000. This is for 2024. Now, if you're over 50 years old, you actually have a catch-up contribution, so you can contribute $30,500, and the total you can put in would be $76,500 if you include the employer contribution. Don't even worry about those numbers for now because it's not important. The point I am trying to make is that if you make a lot of money, you're a high earner, a W-2 income, and you contribute to your 401k, it's pre-tax, so you get a big tax deduction. So put money into this account, get the tax deduction, and then by the time you're in retirement, if you're in a lower tax bracket, you'll pay a much lower ordinary income tax than you would have, had you just taken that salary in the first place and not invested it in the 401k. Okay, and number 7 is muni bonds. These are bonds issued by your local and state government, and they are generally speaking tax exempt at the federal level and the state level too if you reside in the state of the bond that you bought. So, for example, if I live in Maryland and I buy a Maryland municipal bond, the interest will be tax-free at the state level and it will be tax-free at the federal level. This is huge for high-income earners because you can pile lots of money into these muni bonds and you can generate interest and not pay any federal or state tax on the interest that you've earned. Okay, and number 8 is the 83B election. Now, this is very important for those of you who work at startups and you're collecting RSUs like their Pokemon cards. The 83B election allows you to pay tax at the time of grant instead of the time of vest. Why is this important? Well, if you expect your company's stock to appreciate dramatically, then at the time of grant, when the price is lower, if you opt to pay a tax, then you're going to pay a much smaller tax because the value of that stock is lower. And then at the time of vest, if that stock is appreciated quite a bit, then you're avoiding that really high tax, because with RSUs, it's generally the reverse. Usually you don't pay tax at the time of grant and you pay at the time of vest. But again, if you're a high earner and you're working in a startup or you've got all these RSUs and you know your company stock is going to go really high, you might want to look into 83B elections because you get to pay tax earlier when the value of the stock is lower and you can save a lot of money on taxes this way. Okay, number 9 is the backdoor Roth. A lot of high earners can take advantage of a Roth IRA, and it's really a shame because it's such a good account. It's not subject to RMDs like a lot of the other accounts are. It makes it very good to pass down to heirs without bumping them into higher tax brackets. However, because you make so much money, you can't contribute directly to the Roth IRA. That's not a problem. You can do a backdoor Roth. So how does that work? Well, you take all the pre-tax money out of your IRA, you move it to your 401k, you fund your IRA with post-tax money, and then you convert that to a Roth IRA. Then you file Form 8606. If all of this sounds complicated, don't worry about it. Make sure that you continue to look it up. Again, the point of this video is just to make you aware of these things. It's not a recommendation. I want you to look these things up or shoot me an email if you want, Raul@DocShopFinancial.com. if you are looking for investment management or financial planning services. But anyway, the backdoor Roth is great because it allows high income earners to actually get money into a Roth IRA and then reap the benefits of tax-free growth. Okay, and the last one on the list before the bonuses is QSBS, Qualified Small Business Stock. What is this? Well, the government wants investors to invest in small companies. And so certain startups, especially in tech, but in a lot of different industries, they qualify as a small business stock. So if you buy stock in a qualified small business and you hold it for at least 5 years, you could earn up to $10 million in capital gains, all tax-free, exempt from federal income tax, exempt from the alternative minimum tax, and exempt from the net investment income tax. There are a lot of nuances to this, so make sure you work with a qualified financial planner or advisor. Very important, but you should look into this. QSBS, great for high income earners. Okay, and now time for the bonuses. Number 1, charitable giving. Number 2, FSA accounts. Number 3, 529 accounts. Number 4, 1031s. And lastly, number 5, opportunity zones. So there you have it. So there is 10 ways plus 5 bonus ways for 15 total ways for high earners, high W-2 income earners to lower their taxes and save a lot of money in the process. I hope you guys enjoyed it. If you are looking for financial planning and investment management, shoot me an email, Raul@DocShopFinancial.com. I'd love to hear from you, and thanks so much for watching.